Welcome back. We have the management of Chola Finance now with us as promised. Remember, rates for certifying, vehicles, both personal vehicles and commercial vehicles, but of course, the impact is much more for commercial vehicles. The rate for certifying these vehicles are fit for use and can remain on road has gone up dramatically, especially for commercial vehicles older than 20 years. So let's try and understand what the implications for the vehicle finance business is from the CFO of Chola Investment Finance, Arul Selvan. Mr. Selvan, good morning. Great to have you with us here. Thank you very much for joining us.
Good morning. Yeah.
These are pretty dramatic increases, sir, on the CV side. Can you run us through what kind of what can we see? What's the right way to think about it before you try and quantify the impact?
See, this is like an essential part of what we need to do when a new used vehicle needs to be sold to a new buyer. So they will incur this cost. To some extent, this will have to be funded by them, and partly it can be funded by us. So we need to understand how this funding impact will happen. But it is not a large sum when you compare the total vehicle cost that needs to be funded out. So I think this is part of the cost that needs to be borne, and it will be borne, and it will move on. On a cycle of 3 years, this number is, even if it is funded, it gets amortized or it gets split into EMI. So it will not be a large differentiator in my view.
Yeah. So you think, at the margin incrementally, do you have any numbers, sir? What are the number of vehicles impacted because of this? Your team would have those numbers, right? And
it all depends on the age of the vehicle also. So that would also mean for us, as you know, we more handle vehicles which are the first time resold. We don't do more than 10 years or 7 years. So around maturity it is 10 years. So the cost on that is comparatively still lesser. So accordingly, our customer profile may not be that much impacted, while it could be slightly higher on further or more older vehicles. So.
You think at the margin, Mr. Selvan, this kind of pushes, sort of raises demand for loans, as you began by saying, possible? And also, if some vehicles are at the margin and cost goes up, it's basically a decision between whether to continue, pay this, or but you said the cost of the new vehicle is much higher. So is it really a trade-off in that sense? Maybe for a few.
If you look at it, what is happening is when the BS4 to BS6 happened, there was a large push into used vehicles because the cost difference between a BS4 and BS6 was wide. And people who would normally even go for a new vehicle opted for a first time changeover of a BS4 vehicle. That is, the second buyer. But this progressively is now reduced because the quantum of BS4 vehicles, which are up to 7 years old, has come down drastically over the years as this BS4 has been completely stopped now. Add to that, the cost of the BS6 vehicles have also come down because of the GST change. Both put together, I think there will be a shift back to people buying new vehicles who used to buy new vehicles earlier and then shifted to used vehicles when the price differential between the BS4 and BS6 become wider. Now, this difference is changing, and now what will progressively happen is only BS6 vehicles will come into the used market, at least for the first changeover, and that way the differential is narrowed and people would more opt for a newer vehicle. We have to experience this. This is my assumption or my hypothesis about how the market will pan out. We need to see how this pans out as we move into the post-GST.
So, Mr. Selvan, morning, sir. So, if you put everything together, in the second quarter, your vehicle finance book grew almost 15-16%. Disbursements in vehicle finance were also healthy at around 10%. So all things put together, including what you just described, in terms of the emission norms having changed, the GST cuts having set in, second half, what is the kind of growth you're seeing in your vehicle financing book, and which part, what will drive it? Is it going to be light commercial vehicles? I mean, what part of the book looks most robust right now from a demand perspective?
In Q2, the large push happened primarily because of two-wheelers and then the passenger car, which where people wanted to take advantage of the reduction in GSTs, and then also the festival season started. You will see this continuing into the Q3, and you will also see on the commercial vehicle, progressively heavy commercial vehicle coming into play. The other factor, especially with regard to Chola, is during periods when cost of funds goes up, we slow down on the heavy commercial vehicle because the yields are low in this particular segment, and we can't really have adequate margins when the cost of fund is high. But now the trend is cost of funds being low. We will now slowly move back into the heavy commercial vehicle segment also. So we see H2 having a reasonably good growth on vehicle finance, and they should end the year with a decent growth around the 18 to 20% AUM.
All right. Hi, sir. Good morning. Good to see you. When I recall, you had cut down on the growth guidance from, I think, closer to the mid-20s to 20 to 22%. Is that gettable, or are you scaling down a little bit? Because some on the street believe actually it will be in high teens. So if you could help us out with clarity on the growth number for this year itself, which was already scaled back a little bit.
We still hold the 20 to 22% growth levels. We should be there by the end of the year for the full year, year on year.
Okay, wanted clarity on that front. Let's focus on the other two aspects then. Credit cost, if you could give us the comfortable level that you're looking at on that front. And also NIMs, you were guiding that things start improving from here on, as the yields improve, as, cost of borrowing as well comes down. Stick to that 10 to 15 basis point improvement. What would be the rough range? Credit cost and NIMs. Please go ahead, sir.
Credit cost will come down a bit in Q3, Q4. This is always the trend in any year if you look at it pre-COVID, and we will experience this. We'll see this coming down. Our guess is at a company level, we will close the year with around 1.5 to 1.6% on the credit cost. This is also primarily the impact on account of the step back from the fintech business, where the credit cost will see some larger proportions as we move into the final legs of running down that AUM of that book, which will mostly run down by end of Q4. So we should close the year by around 1.5, 1.6 at the company level on the credit cost. But the NIMs will improve. NIMs are improved in Q2. You'll see similar levels with further, 5 to 10 basis points improvements in the Q3, Q4 numbers. So overall, you will see around 20 to 25% movement in the NIMs as compared to last year.
Okay, all right. Let's focus on the other parts of the business, the housing finance as well as LAP traction. How has that been? If you could give us some color there, sir.
Both LAP had been growing at a decent pace, around 30% plus on the AUM, and it will see the similar growth. It is not impacted either positively or negatively by the cost of funds because it's a floating rate book, so it will continue to deliver the ROAs it has been giving. So that's a good business. We have sort of stabilized it, and it is running at a good, decent pace and adding to the bottom line in a decent way. On the home loans, there has been a little bit of a slowdown on the disbursements, primarily because of a certain SRO-related, issues with regard to Qatar and etc. in certain pockets of certain states. But this is getting addressed, and I think progressively you'll see in the second half disbursement also growing. While disbursement slowdown, AUM was growing still at around 20% plus, and you'll see that the full year we will still close the home loan book at above 20% mark.
Okay, what about the competitive intensity? PSUs, they are being a little aggressive in the home loan space. Have you seen that?
We have never been in the same market as PSUs. PSUs more focus on salary. We are in the self-employed non-professionals. Our competition is more with other NBFCs and housing finance companies so we don't see being our competition there.
Good to get clarity, sir, on that front. And finally, ROAs should be closer to around 2.4% odd. I think it was around 2.2%, the last number that I have recorded.
Yeah, I would keep it between 2.2 to 2.4. Let's keep it conservatively because you always take the higher side numbers.
No, sir, I take what you say. I'm happy to ask you the questions. What you take, I hold you to that number. So you're saying 2.2 to 2.4, you want to keep it in that range.
Yes, yes.
Pleasure talking to you, sir. Thanks a lot for joining in.
Thank
Wishing you all the
Thank you.
best. And, we catch up either later this year or early 2026. Thanks for joining in.